This question tests knowledge of modern budgeting techniques, specifically the concept of a rolling budget, continuous budget. Budgeting is an essential management accounting tool used for planning, coordination, and performance evaluation. Different budgeting methods are designed to meet different managerial needs, such as flexibility, cost control, or continuous planning. The key phrase in the question is continually updated to add a new budget period as the most recent budget period is completed. This describes a budgeting system that never ends. As one budget period, for example, 1 month or 1 quarter, expires, another future period is added so that management always has a budget covering the next fixed planning horizon, such as the next 12 months. This continuous updating allows organizations to respond more quickly to changing business conditions and maintain a forward-looking planning perspective. A. Activity-based budget. Incorrect. Activity-based budgeting, ABB, develops budgets based on the activities required to produce goods or services and the associated cost drivers. It focuses on activity analysis rather than continuously extending the planning horizon. B. Flexible budget. Incorrect. A flexible budget adjusts budgeted costs and revenues to different activity levels after actual output is known. Its purpose is performance evaluation under varying production volumes, not continuous updating of budget periods. C. Rolling budget. Correct. A rolling budget, or continuous budget, is updated regularly by adding a new budget period whenever the current period ends, ensuring that management always has a complete forward-looking budget. For example, after January ends, the company adds the following January to maintain a 12-month planning horizon. D. Zero-based budget. Incorrect. Zero-based budgeting, ZBB, requires every budget item to be justified from zero each budget cycle. It concerns budget preparation methodology, not continuous budget updating. Correct answer. C. Rolling budget. This continuous planning approach helps organizations remain responsive to changing market conditions and improves forecasting accuracy. Therefore, the correct answer is C. Rolling budget. This question tests understanding of the difference between static budgets and flexible budgets, a fundamental topic in management accounting and performance evaluation. A static budget is prepared for a single planned level of activity and remains unchanged regardless of actual production or sales volume. In contrast, a flexible budget adjusts revenues and variable costs to the actual level of activity, making it a more useful tool for evaluating managerial performance. The key phrase in the question is, when compared to static budgets, flexible budgets. Students should remember that a flexible budget eliminates the effect of differences in activity levels, allowing management to compare actual results with what costs and revenues should have been at the actual level of operations. This provides a fairer basis for performance evaluation and variance analysis. Offer managers a more realistic comparison of budget and actual fixed cost items under their control. Incorrect. Fixed costs generally do not change with activity levels, so flexible budgets provide little additional benefit for comparing fixed costs. The major advantage of flexible budgets lies in adjusting variable costs and revenues, not fixed costs. B. Provide a better understanding of the capacity variances during the period being evaluated. Incorrect. Capacity variances relate primarily to fixed overhead analysis, whereas the primary purpose of a flexible budget is to adjust costs and revenues to the actual activity level for performance evaluation. C. Encourage managers to use fewer fixed cost items and more variable cost items that are under their control. Incorrect. Flexible budgeting is a planning and evaluation tool. It does not encourage managers to change the cost structure from fixed costs to variable costs. D. Offer managers a more realistic comparison of budget and actual revenue and cost items under their control. Correct. A flexible budget recalculates expected revenues and variable costs based on the actual activity level, allowing managers to compare actual performance with a realistic benchmark. This removes distortions caused by differences between planned and actual production or sales volumes and provides a more meaningful evaluation of managerial performance. Correct answer: D. Offer managers a more realistic comparison of budget and actual revenue and cost items under their control. Exam tip: because a flexible budget adjusts revenues and variable costs to actual output, it provides a more realistic comparison of budgeted and actual performance, making choice D the correct answer. This question tests knowledge of the Schedule of Cost of Goods Manufactured, (SOGM), an important report in managerial accounting that summarizes the manufacturing costs incurred during a period and the cost of goods completed. Students must distinguish between the Schedule of Cost of Goods Manufactured and the Schedule of Cost of Goods Sold, COGS. The key point is that the COGM schedule focuses only on production costs, including a direct materials used, a direct labor, a manufacturing overhead applied, the beginning and ending work in process, WIP, inventory. In contrast, finished goods inventory is not part of the COGM calculation. Beginning and ending finished goods inventories are used later in the cost of goods sold schedule to determine the cost of products actually sold. A. Ending work in process inventory. Incorrect. Ending WIP inventory is deducted when calculating cost of goods manufactured, so it appears on the schedule. B. Beginning finished goods inventory. White heavy check mark correct. Beginning finished goods inventory does not appear on the Schedule of Cost of Goods Manufactured. It is used in the cost of C. The cost of raw materials used. Incorrect. Direct materials used are a major component of manufacturing cost and appear on the COGM schedule. D. Applied manufacturing overhead. Incorrect. Manufacturing overhead applied is included in total manufacturing costs and appears on the COGM schedule. Correct answer: B. Beginning finished goods inventory. Exam tip: remember the distinction. OGM schedule: direct materials plus direct labor plus manufacturing overhead plus or minus WIP inventory. COGS schedule: beginning finished goods plus SOGM minus ending finished goods. If you see finished goods inventory, think cost of goods sold, not cost of goods manufactured.